One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy.
What does a revolver mean, and how can companies use it in an LBO? Welcome to Investment Banking Insights. All right. Welcome to Investment Banking Insights. This is the show dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. My name is Alex Mason, and I am your host. Thank you so much for joining me. And guess what? We did it. We finished going through more mergers and acquisitions questions. We finished going through a lot of advanced concepts there. I hope you enjoyed that. Let's now transition to leverage buyouts. Let's get back into LBOs, my friends. Leverage buyouts, we're going to tackle some of the more advanced concepts. And today we're talking specifically about revolver loans. We're trying to understand the different types of leverage that businesses can use for leverage buyouts, because that's part of the name, right? Leverage buyout. But the thing is about leverage that not all forms of leverage are created equal. There are many different forms of debt out there that companies can borrow, similar to how there are different types of mortgages you can get to finance the purchase of a home, for instance. You could get a conventional loan, an FHA loan, a VA loan, etc. And each of those different types of loans have different characteristics. And so you want to pay attention to this. So today we'll talk about one of these debt types. And then in the next couple of episodes, we're going to cover some more. But for now, let's go ahead and talk about revolvers. Revolvers are one of the more common debt types that conservative banks use when they're lending to businesses. And this type of debt is considered quote unquote senior and quote unquote secured. So what do those terms mean? Well, senior means that it's first in line in the capital structure to be paid back. Now, senior, you can contrast this to something like junior debt. So for example, senior debt would be paid before shareholders. So secured, that means that this debt is backed up by some type of asset. So in this context, secured means that the loan is secured by the company's assets. So if things were to go south with the business, there's a decent likelihood that the business can sell off some or all of its assets and pay back this debt. So that's what secured means. In contrast, if you have unsecured debt, that is a debt type that doesn't have any assets backing it up and therefore makes it more risky. Okay, so let's go ahead and talk about some of the characteristics of revolvers. Revolvers, the way I think about them, they're like credit cards for businesses or like a home equity line of credit is for a homeowner. It's very typical for companies to get revolver accounts with a bank because they have the lowest interest rates out of all the different types of debt that we're going to discuss. So the interest rate, it is low, but it is typically a floating rate, which means that the interest rate will adjust up or down according to how the prevailing interest rates in the market are moving. So that's why things like the rate of the 10-year treasury are so important, or the Fed funds rate, because those rates influence the real floating rates on loans like these. As far as how long these loans are for, also known as the duration or the tenor of the debt, it's typically 3 to 5 years. So relatively short-term period for this kind of debt. Now, on another note, this type of debt cannot be amortized. So remember amortization, with different types of debt, you can spread out the cost over time. Well, with revolver debt, you can't do that. So that's another thing. And then another thing about revolver loans is this type of loan does not have what's called call protection. What is call protection? Well, this is when the issuer of the debt protects itself from having the loan principal paid back early. So imagine that you're the bank and you lend money to someone. I mean, you don't make that much money if someone pays off their loan in a year, right? You kind of want to stretch that out so you can collect your interest year after year after year. And then maybe after 5 years, maybe after 10 years, you collect all that interest and you collect all your principal and you feel good about yourself because you just made a lot of money. But if someone pays off that loan early, then you're not going to make as much. So that's what call protection is for. It protects the issuer of the debt from having their principal being paid back early. Now, where this terminology comes from is in the context of bonds. A bond is quote unquote callable when the issuer can demand the principal be paid back before the term of the bond ends. So in this context, banks actually don't protect themselves with this type of debt from the borrowing company potentially paying it off early. The company can pay off the debt whenever they want. So that's good for the company, not as good for the bank, but that's just how it is for this type of debt. Remember, this is one of the more highly prized types of debt because of these kinds of features. And then let's also talk about covenants. Now, we mentioned this briefly on the podcast some episodes ago, but let's go ahead and talk about it again. What is a covenant? Well, the covenant is a clause in a debt contract that places some kind of restriction or requirement on the borrower. Basically, it helps lower the risk of whoever's issuing the debt. So the covenant type for the revolver loans are called maintenance covenants. And what this means is that a company borrowing the money has to maintain some kind of performance in order to keep that loan. And this varies, but it could be related to a certain debt to EBITDA ratio, for example. And a bank might put this in place because they don't want the company to have too much leverage, because then they may not be able to pay back the leverage that they're giving them. Or there might be minimal thresholds for revenue, etc. So that's another thing. You might have these maintenance covenants with revolver loans. So in general, kind of wrapping this up, revolvers are an attractive type of debt for companies because they tend to have the lowest interest rates and they can be paid back whenever the company wants before the deadline in the contract. So it's basically, the way that I think about it, it's just kind of like a big credit card account for the company. And it's very common for companies to have this type of debt. Okay, that's what I got for you today here on Investment Banking Insights, talking about revolvers. We're going to talk about more types of debt that can be used in an LBO in the next episode. So be sure to come back for more tomorrow. Until then, my name is Alex Mason, your host. Have a wonderful, wonderful day. Take care.